Hi guys, welcome back to our channel. For those of you who don't know me, my name is Matabelo Mapangela, and yeah, to all the returning subscribers, welcome back. To all the new subscribers, we see you, we appreciate you, and welcome to the family where we advocate for holistic wellness in its entirety, looking at your personal finances, looking at your relational wellness, looking at your emotional wellness, and so forth. So I do hope that you will enjoy the content on this channel to be very fruitful, but more than anything, I hope that you will be able to get key takeaway points that you will be able to apply. So getting into today's video, today I'm doing a video that I have promised. So today we are talking about what determines the interest rate that you pay as an individual. So we spoke about the inherent factors that determines the interest rate that you pay. For instance, are you taking a secured or unsecured loan, or are you taking a loan on a fixed interest rate, or are you taking a loan on a variable interest rate? So those are the inherent factors that determines the interest rate that you pay. But today we are talking about the individual. At an individual level, if I, Matapelo, go to a bank and borrow, what is the interest rate that the bank will charge me, and what determines that interest rate, right? So first things first, let's start by defining what is an interest rate. So an interest rate is the cost of borrowing that the bank will charge you for lending you money. So I will repeat, it is the cost of borrowing that the bank will charge you for lending you money. So if I'm to simplify, the interest rate that you are charged is a reflection of your risk. So of your risk as an individual. So what do I mean by your risk? So the reason why the bank charges you an interest rate, number one, is because they need to make profit, but also the interest rate is a reflection of whether you will be able to pay back the amount of money that you have borrowed, but will you also be able to pay back the cost of borrowing that is associated with the amount of money that you have borrowed, right? So the interest rate that commercial bank charges us is called the prime lending rate. So the other question would be, what determines the prime lending rate? So the calculation or the formula to calculate the prime lending rate, you will take your repo rate. So like I have explained in the other previous videos, I think I will link it in this video. So if you take your repo rate is the rate that the South African Reserve Bank charges commercial banks when they borrow money from the South African Reserve Bank. So the formula is, you take your repo rate and then they always add 3.5%, and then you will get your prime lending rate. So it will be your repo rate, which is currently 3.75% plus 3.5%, and then it will give you the current prime rate, which is 7.25%. Right? However, this does not mean that when you go and borrow as an individual now, so this does not mean that as an individual, when you go and borrow, you will be charged the prime lending rate. Bank has a discretion to charge what we call a prime lending rate plus. So a prime lending rate plus, it means the prime lending rate plus a certain percentage, right? So what determines that certain percentage, or what determines whether I will be charged the prime lending rate or I will be charged the prime plus lending rate? So there are various factors that determines whether you will be charged the prime lending rate or whether you will be charged the prime lending plus rate, right? And the first one that determines this is what we call a credit risk assessment. So when you go and apply for debt, the bank will do what we call a credit risk assessment. So in simple terms, the credit risk assessment will show your ability to repay the loan that you have borrowed and to repay the interest rate on the loan that you have borrowed, right? But these are divided into various factors. So these factors are in no particular order. It doesn't mean that when I start with the first one, the bank will also start with the first one. But all of them are important, and all of them are considered by banks when you borrow. So let's get into the presentation. So the first one will be your credit score, right? So your credit score, we have I normally use the clearscore.com. It will give you what your credit score is. So the higher your credit score, the lower the interest rate that you will be charged. And if your credit score is lower, the higher the interest rate that you will be charged. So your credit score will indicate two things. It will indicate your credit history. What do we mean by a credit history? A credit history will indicate over a certain period of time what has been your credit record. Have you undertaken debt? Were you able to honor your monthly debt repayment? What were some of the debts that you have undertaken? Did you take your secured or unsecured loan? Did you finish paying off the debts that you have undertaken over the past, for instance, 24 months? 24 months. So those are the different things that a credit history will show. And then it will also show your payment history. Are you that person who decides, oh no, next month I'm not going to pay my debt, or I'm just going to pay 50%? Your credit score will also indicate that. Are you someone who honors their debt or their monthly repayment obligations, or are you someone who defaults frequently? Is there a certain pattern where actually in December you don't honor your debt obligations? So those are some of the things that the credit score will indicate that, okay, there is some sort of a pattern. In December this person does not honor their debt obligations, or actually in January this person does not honor their debt obligations, or actually this person has been paying their monthly debt repayment on a consistent basis, but they have actually been adding an extra 500 rands or an extra 600 rands. So those are some of the things that your credit score report will show you. You actually have access to this report. I do this on a month-to-month basis, whereby I would just go to clearscore.com and then download my credit score report. I normally just assess what has improved, what are some of the areas that I can improve on. So I would really recommend that you familiarize yourself with your own credit score, so that when you actually go and borrow, you actually have a sense of where you are, and what are some of the things that the bank will look for. And then the second one is the loan amount. So the amount of money that you are borrowing, whether you like it or not, has an impact on the interest rate that you will be charged. The higher the amount that you borrow, the higher the risk that you will repay the bank. So the higher the interest rate that the bank will charge you. The inverse is true. The lower the amount of money that you borrow, the lower the risk attached to it, and therefore the lower the interest rate that the bank will charge you. And then the third one is the loan term. So the loan term simply indicates your loan repayment period. Is it 24 months? Is it 48 months? So is it a short-term loan or is it a long-term loan? So if your loan is a short-term loan, the monthly repayment will be higher, but the interest rate will be lower. And then if your loan term is longer, the monthly repayment will be lower, but the interest rate that you will be charged will be higher. Right? And then the third one, it's the interest rate type. I've spoken about this in a video. I explained that there are two types of interest rate that you are charged. You have your fixed interest rate, and then you have your variable interest rate. So the type of interest rate on your debt also has an implication on the interest rate that you are going to be charged. If you take a fixed interest rate loan, the interest rate that you are going to be charged will slightly be higher. Whereas if you take a variable interest rate, the interest rate that you are going to pay on your debt will slightly be lower. Also, I would recommend that you also refer to that video, so that you can get an idea of what is the difference between the two and what are the pros and cons of each. And then also the loan type also plays an important role on the interest rate that you are going to be charged. Are you taking a secured loan or are you taking an unsecured loan? So a secured loan, it's a loan that has a security attached to it. So the security will be in the form of an asset. The typical one will be your loan, your home loans, and another one will be your vehicle finance. And also another thing to note with this, because there is a security attached to the loan, the bank will normally do a valuation of that asset. Is the asset valued at the amount of money that we are borrowing you. So if you take a vehicle finance, the bank will also go and inspect that car that you are buying to say that, okay, what is the value of this car? If we are borrowing Mathapelo 150,000 to go and buy this car, what is the actual value of this car? And if Mathapelo defaults in the next 2 years and the bank decides to repossess the car that Mathapelo bought, so that the bank can resell it to be able to recover the amount of money that they borrowed Mathapelo, will they be able to recover part of the amount or part of the outstanding balance 2 years later? So those are some of the things that you need to take cognizance of. And also with the home loan, the bank will also go and do a property evaluation to check the value of the house and all of those things, right? And then with an unsecured loan simply means that there is no security attached to the loan. You are just going to the bank to borrow for your own personal expenses. You can an example can be a personal loan or a student loan or a credit card. So those are some of your so that is the difference between a secured and unsecured loan. So with a secured loan, because there is a security attached to it, security meaning that in an event that you default, the bank will still be able to recover some of the amount of money that they have borrowed you, so the interest rate that they charge you is lesser. Whereas with an unsecured loan, in an event that you default, the bank cannot come and say, actually, what did you do with the money that we have borrowed you? Okay, so did you buy clothes? We are going to repossess the clothes that we have borrowed you. It does not work like that, right? So with an unsecured loan, because in an event that you default, the bank will not be able to recover the amount of money that they have borrowed you. What they will do is they will charge you a higher interest rate. Right? And then the other thing that you need to be mindful of when you go and borrow is your debt to income ratio. Right, so a debt to income ratio is the ratio that your lenders use to measure an individual's ability to manage their monthly repayments and their ability to repay their debts. So the formula is you take your total monthly debt repayment. So the keyword is total. All the debts that you have, you add all the monthly repayments, and then you divide it by your gross monthly income, not net, but gross monthly income, and then you multiply it by 100. Right, so the lower the debt to income ratio, it means there is a good balance between your debt and your income. So the bank will slightly charge you a lower interest rate because of the risk factor. It means that you are able to manage your debt. And then if the debt to income ratio is higher, the bank will charge you a higher interest rate because it simply indicates that actually Mathapelo has a problem with managing her finances. It should actually be the inverse, right? Whereby if the bank can see that Mathapelo is struggling, so let's charge a lower interest rate. It doesn't work like that. Banks are not charity cases. I don't want to say banks don't care about you, because it might be true, but yeah, so it doesn't work like that. The higher the risk, the higher the interest rate. The lower the risk, the lower the interest rate. I mean, if it was a charity case, they should be doing the inverse, whereby if the risk is higher, I mean, we want Mathapelo to have a good life, so let's charge her a lower interest rate, and then if Mathapelo is actually doing well, let's charge a higher interest rate. It doesn't work like that, unfortunately. And then the other thing that the bank looks at, it's your employment type. They normally ask you these questions. So they are not asking you these questions because out of boredom, or they're just asking you. So all of these things determine the interest rate that you are going to pay. They will ask you, oh, okay, are you self-employed or are you an entrepreneur? And then if you're an entrepreneur, they will even ask you to submit a 6 months bank statement so that they can get some sort of assurance that actually this person is making money on a consistent monthly basis, on a weekly basis. But there is some sort of income that is coming into this account. They will even ask you, are you a permanent employee? So if you are a permanent employee, they know that, okay, so if you are hired permanently, the likelihood that you might lose your job is lower. It doesn't mean it won't happen, but the likelihood of you losing your job is lesser. And then they will even ask you, so are you employed on a contractual basis? And guys, with banks, It doesn't mean that when you are employed on a contractual basis, they won't give you the loan. They will give you the loan, but they will charge you a higher interest rate so that they can recover as much from you as possible. What they will normally do, they will try to cap the debt that you are undertaking within your the period of your contract. And then the other thing that the bank looks at is what we call your discretionary versus your non-discretionary expenses. I know a lot of people are not aware of this. So when you take a debt, the bank will ask you, so what are your monthly expenses? So in addition to the income that you have indicated that you earn, so what are your monthly expenses? So you will say things like your rent, you will say things like your clothing, you will say things like entertainment. And the key thing is be as truthful as you can possibly be when you do that, when you indicate your expenses. Because sometimes we like to underestimate our expenses so that we can qualify for debt. But what that does is that you will get that debt, but you won't be able to maybe add an extra 200 rands or or add an extra 500 rands, or sometimes you might not even be able to honor your debt obligations because you know that your finances are constrained. But because you wanted this loan so bad, you ended up understating your expenses. So when you state your expenses, the bank will then decide which ones are your discretionary. I know others have two columns, so they will say to you, write your essential expenses and write down your non-essential expenses. So after that, the bank will look at, so the bank also take that into cognizance to say that, okay, even though this person's debt to income ratio is lower, this person actually has a lot of expenses that are non-discretionary. So those are expenses that are essential. So what does it mean? So it means that this person is actually a high risk, so let's charge a higher interest rate. So yeah, guys, those are some of the things that determines the interest rate that you pay as an individual. Let me know if you have enjoyed this video. But more than anything, let's engage in the comment section below. Let's have a discussion. What are some of the things that you know that the banks that banks look into when they calculate your interest rate as an individual? I hope you enjoyed this video. Don't forget to give it a thumbs up if you did. Don't forget to comment, and most importantly, don't forget to subscribe. It means a lot to us. I love you guys so much. And yeah, until the next video, God bless you and bye bye.